Well, the jobs report came out today, and apparently we have a big problem. Non-farm payrolls for last month that were previously 12,000 were revised up to 36,000. This month, well, at least last month for November, you came in at 227,000. The estimate was around 200,000, so that beat, but under the surface, there's a big problem. Also worth mentioning, the unemployment rate ticked up from 4.1% to 4.2%, but Nick Timmerhouse puts it well here. He says the unemployment rate, arguably the best summary statistic in the monthly jobs report, ticked up to 4.2% in November. Unrounded, it was 4.246%, leaving it very close to the recent high of 4.253% recorded in July. Job growth in the establishment survey has been fine, but the household survey showed the share of Americans, including the 25 to 54-year-old cohort, who were working in November was down from a year ago. The number of unemployed at 7.145 million was also close to the July high of 7.163 million. So you're actually sitting at almost the highest unemployment rate we have seen in years. I mean, you are at the levels in which we had a growth scare in markets prior. That is a problem. That is a problem because markets are priced for economic perfection. And if things weaken further from here, which looks like the trajectory that we are on, we could soon have another growth scare. And I think that's probably what gives us that correction in Q1 of 2025. It's starting to look a little bit more obvious following today's economic data. You can also see here that full-time jobs were actually negative 111,000. Part-time jobs were negative 268,000. And this is, of course, the household survey. So the household survey is very much different than the establishment survey, and this is suggesting even more weakening than what we previously thought. The reason why markets are taking this as a bit of a positive today is because the odds of a December 18th Fed rate cut are basically confirmed. You're now sitting at 89.4% chance of a December 18th cut. Yesterday, you were at 73.3%. So odds jumped a lot today following that jobs report. And it's pretty much a certainty now we get a cut December 18th. Now, the question is, how does the economy evolve from here? Do things get worse from here or do they get better? And that, my friends, is the big question. For January 29th, 2025, Wall Street is expecting a pause. Okay, we are expecting rates will be paused, 65% chance of that. There's a 27.7% chance of another cut, January 29th, 2025, and a 7.3% chance of nothing between now and January 29th, 2025. And I have to say, following this jobs report today, you have to be a little nervous on where markets are with valuations where they are priced for perfection, but yet we are now back up to basically the same unemployment rate we were at in July when we got a correction based on growth scares. Now, I do think momentum is to the upside. I do think, quote unquote, animal spirits are out there. So I'm not expecting this is going to immediately cause some kind of large correction, but it's not good where we are now. If, let's say, the next month is worse, you're going to see a big problem for markets. Now, again, is that going to start here in December? Probably not. I think there's reasons, to believe a year-end rally is most likely at this point. But at some point in Q1, a day of reckoning is likely coming for markets. And what's actually interesting about today is, yes, the Russell is up 1/3%, the NASDAQ up 0.75%, S&P up around 1/4%, the Dow is down 0.14%. But look at the VIX. The VIX is down 5.32% today. There is a massive de-risking happening. With the VIX under 13 now at 12.82, there's not a lot of fear out there. Again, even though we had a really bad jobs report today. Like, the headline numbers look good, but the household survey was terrible. The actual unemployment rate skyrocketed, and the markets are not concerned about this as of right now. But it does feel a little complacent because we're back to the same unemployment rate we were when recession fears started to really rise in July and August. You know, that's not comforting to me as even someone that is fairly bullish. Now, I have held the view for quite a long time now that we're really not going to know if we're going to have a soft landing or not until probably at least midpoint of 2025. Wall Street's jumped to the conclusion of we're guaranteed going to have a soft landing. I don't think you can guarantee that at this point, especially with the data that's coming out right now. So the issue is, as markets are priced for, you know, a guaranteed soft landing, a guarantee of no recession, as the data worsens, you gotta change your consensus view a bit. And as people start to grow more concerned about a recession, that's where you see markets that will come down, especially with the valuations that we are currently seeing. Now, if we take a look at the CNN Fear and Greed Index, it's currently at 54, which is neutral. Yesterday, it was at 55, so a little bit less bullishness you are seeing today versus yesterday, and especially down from a week ago when the CNN Fear and Greed Index was at 67. Okay, so the bullishness, I guess, if you will, has died down a little bit, but you're still sitting at pretty much price to perfection kind of levels. Market momentum, extreme greed, stock price strength is fear, stock price breadth is fear, put and call options, extreme greed, market volatility is neutral, safe haven demand is fear, and junk bond demand currently in fear. If we take a look at the percent of stocks trading above their 50-day moving average, you're sitting at 61.00%, which is kind of in the normal range that we have been at for the last couple of months. You're down about 0.5% today. So the average stock declining a little bit. You can see the RSP also going negative, at least at the time of recording this video. So I don't think that's a great sign. Also, when you look at the AI Investor Sentiment Survey, you went from the highest level of bulls or highest level of bears as of November 27th to that absolutely collapsing from 38.6% down to 30.7%. Neutral investors also fell quite a bit from 24.3% to 21.0%. And bullish investors skyrocketed from 37.1% to 48.3%. So some very weird, volatile readings that we're getting from this AI Investor Sentiment Survey. Now, what's even more strange is the Michigan consumer sentiment data that we got out today. The headline number came in at 74.0. That's up from last month at 71.8. But take a look at this. Consumer expectations came in far below expectations at 71.6. Last month was 76.9 versus estimates of 77.3. So you came in like 6 points lower than the estimate. But current conditions skyrocketed from 63.9 last month to 77.7. So future expectations plummeted, but current conditions skyrocketed. You don't see that all the time. 1 year inflation expectations came in at 2.9%. Last month you were at 2.6% versus expectation of 2.7%. So some very weird things going on here. 5-year inflation expectations fell to 3.1%. from 3.2% last month. Also being reported today, 50 counterparties take $130 billion at the Fed reverse repo operation. These numbers have fallen a lot as of recent months. And as you get closer to being at zero, some of the Fed's, quantitative tightening, them running off their balance sheet, will start to come to an end as this money starts to fall even lower. Fed Daily today said the labor market remains in a good position and is balanced. Fed Goolsbee says a single month's data is not reliable, but if the household survey were to show steady deterioration, the Fed would have to look at it more closely. And yeah, it has been steadily deteriorating. So Fed Goolsbee saying, oh crap, maybe things are not as good as we thought they were, just looking at the household survey, that is. Fed Goolsbee says the outlook does matter, so when the new administration starts proposing policies, the Fed will start to think through it. He says it is likely that goods prices will return to deflation, services will continue in the right direction, and market data on housing suggest coming improvement there. He says, I'll be watching interest rate sensitive sectors and the lagged impact of monetary policy for signs that the neutral rate is approaching. He says the speed at which the Fed is moving will probably slow as the debate proceeds on a stopping point. And he says economic conditions will determine the pace of rate cuts from here. He also says a gradual pace of rate cuts seems appropriate. Fed Hammock says that housing inflation is going to take a lot longer to come down. The funniest part about this is if you actually look at market rents, housing inflation is no longer an issue. Like you're negative on a year-over-year basis. But it's the way that the Fed and the government calculate housing inflation with homeowner equivalent rents that is just a flawed way of getting the data. Fed Hammock says that data will drive what the Fed does with monetary policy, and she says that she expects solid growth, low unemployment, and gradual inflation ebbing. And one of the biggest headlines today is she says the economic landscape calls for modestly restrictive monetary policy. So it does seem like a lot of your Fed officials, besides Fed Goolsbee, is not even acknowledging the fact that the unemployment rate just skyrocketed today. Like not by a small amount, but by a large amount. If you just look at the rounding factor, then it only went up from 4.1% to 4.2%, but you're on the high end of 4.2%. You almost came in today at 4.3% unemployment for the unemployment rate. If you also look at the household survey, like Fed Goolsbee said, there's starting to be an issue there. And again, it's not something the markets are paying close attention to now, but you're one more bad report away from a growth scare in market. So is this time to panic? No. In fact, this could actually provide a little bit of a boost in December, but it does highlight that there's probably a mismatch between market expectations and the reality of the economy. Okay. Even if, again, we don't have a recession, even if things are fine, it's probably not as good as a lot of people are expecting. Just remember, back in July and August, everyone started to call for a recession. Well, now you're back up to the same unemployment rate, almost exactly the same unemployment rate you were at then, but yet nobody's talking about a potential recession. And that's where some of my nervousness is starting to come in. I still think this is more of a Q1 2025 issue, that I don't think Wall Street is really going to care about this in December. Just look at the VIX. You're really de-risking. But the risk curve is starting to widen for Q1 2025. Basically, the premiums in options are pricing in some downside volatility in Q1 2025, but not throughout the rest of this year. Everyone's kind of expecting Q1 2025 is going to have some issues, but the ending of this year could be smooth sailing to a certain degree. So what I would do with this information personally, if you're listening to this video and you're long this market just like I am, is watch out for signs of froth. Watch out for an overextended market. Do I think at 607.73 on the SPY that you're in immediate danger of falling? No, I think December could probably be a good month. But let's say you get up to 615 or 620 on the SPY heading into 2025, that would likely be the opportunity to take a short on this market to hedge portfolios. Now, if you're someone that's just long and you want to take a profit and raise some cash, I don't think there is anything wrong with that whatsoever. I think that's probably the prudent thing to do, especially if we can almost with certainty expect a correction over the next 3 to 6 months. You're probably going to have a better buying opportunity to buy the stocks that you want, right? They're probably going to fall in price before they go up another 25%. Okay. Just obviously my thoughts. I don't think it's necessarily time for a short just yet, because I think December is going to kill you on theta if you do that, because I don't expect to get a big drop in December. But if markets do overextend further from here, with the data that we got today, I think it would be an opportune moment to take on a short or a hedge on the portfolios if we do rise, further from here. If we're 620 by the start of 2025, that would be a very good moment, I think, to hedge the portfolio a bit. So just my opinions. Obviously, let me know what you guys think about this down below in the comment section. You guys have a fantastic rest of your day, and I will see you in the next one.